Good evening, everyone.
Good evening.
Welcome to the day 5 of Margadarshi, keeping pace with the future of management. Today, we are going to discuss about the topic what investors can learn from the history of Indian stock markets and its return. So, today we have our speaker, Dr. Balasubramanian P, currently business, Coimbatore Campus. About Dr. Bala, he has a 25 years of experience in teaching and research and 2 years of industry experience. He completed his PhD from Jawaharlal Nehru University. He teaches core courses in economics and elective courses in finance like financial derivatives, financial modeling, and valuation in MBA program. And uh, he also teaches behavioral economics for PhD scholars. Over to you, sir. Welcome to the session.
Good evening, everyone. And I'll be covering what investor can learn from history of Indian stock market and return. If you look at history of Indian stock market anywhere across the globe, people sometimes have a fear, extreme fear, and extremely greedy. In India, during COVID time, stock price crashed like anything. There was extreme fear. Then market started going up. The greed started. Lot of IT employees started trading. They made some money. They are carried away by this bull market, their predictability. They are very overconfident. So you must be seeing a lot of companies newly listed, Zomato, Paytm, or over the IPO price gone up by almost 80 to 100%. Then back to IPO price, some even below that. So why this happens? What history teaches us? Particularly youngster, they have strong belief in their predictability of the market, but they not look at the historical data. So they have overconfident bias. They think that they have strong predictability, but you see slightly some different if they are older. They have seen many ups and downs of stock market, bear market particularly. In their memory, it is very strong. So they fail to invest in the equity, in the long-term investment. They go for some safe instrument, some life insurance policy, a money-back policy, or safe fixed deposits in a bank or non-bank finance companies. They look for evidences, confirms their view. The market is bad. They look for the stock scams and other things. They don't invest in the stock market. If you look at the historically, both bull market and bear markets are frequently happening. So some day traders are there. The day traders are those people trade daily. These day traders, there is a saying in social media, common to me, that 95% of the trade traders lose money. Still people trade. Why? So historically, but strong evidence from research studies shows Douglas Jordan and David Dills in 2003 study shows approximately 20% of the trade traders were more than marginally profitable, just marginally profitable. And twice as many as trade traders lose money as make money. This is a study. So people lose money, but still trade traders are there. And Brad and Barber et al. Shows aggregate performance of trade trader is negative. Aggregate performance of trade trader is negative. 74% of trade trading volume is generated by traders with history of losses. So history of losses, 74% of the trading volume losses. 97% of the trade traders like to lose money in future trade trading. It shows their overconfident bias, their bias learning. Still, they are not rectifying. They have strong belief in themselves, but they make mistake. They don't learn from the mistakes. So it repeats. So why people are not learning from mistakes? But similarly, those don't invest in the stock market, they put money in the fixed deposits or other safer investment. They also miss the opportunity. Sensex in 1980 was index value was 120. Sensex is the Bombay Stock Exchange sensitive index. Its base year is 1980, that is 100 that year. So Sensex 1980, somewhere in the end of the year, it was 123 index value. It is 30 stocks value. The 100 in 1980 at the beginning of the year. Actually, this end of the year around December 123. Now Sensex today 58,000. What do you mean by that? If you invested 123 in 1980, it would have gone to 58,000 rupees. Or if you invested 100 rupees in 1980, it would have gone to 47,500. 15.8% return. So in the long run, it is around 41 years of period, they're getting 15.8%. Even 20-year duration, you will similar return. Even 50-year duration, almost similar. If you put the same 100 in the bank deposit at the rate of interest of 7% in 1980, it would have grown to 17,000. So, investing in stock market gives almost 3 times more, 2.8 times more. But some set of people miss this opportunity. But some set of people, they do frequent trading, youngster, they have overconfidence of predictability and lose money. Both are there. And also, other category, those are mature. There is a group of people invest in mutual fund, invest in equity, the stable return, they get good return. Look at biggest stock market crashes in India on 23rd March 2020. You know all because of COVID. That day, Sensex last single day 3,943 points. The percentage wise 13.15%, 13% loss. You know that investor, they can trade on margin money. So with 1 lakh of margin money, they can trade around 4 lakhs worth or 5 lakh worth share. Suppose I have only 1 lakh, but I can leverage myself, and with the margin, I can trade up to 4 lakhs or 5 lakhs value, depends upon the margin amount for the particular stock, for the portfolio of stocks. When I trade on the leverage, if 13% loss on one day, suppose this average market average, some stock might even lose 20%. In that case, I might lose entire 1 lakh or almost 60-70,000 I lose. Just I left with 20-30,000 rupees. So that's what happening. The youngster, because of overconfidence, they lose money. During 1992, Harshad Mehta scam, his Sensex lost 570 points. That is 12.77%. So again, same, you will lose 5 crore entire money you are putting if you are a day trader. Even those investors, they don't have optimism, they don't have mental stability. They might also, when falling market, they might sell their entire portfolio. And 2008 US financial crisis, 24th October, again led to 10.9% fall. The COVID, you see, 3 times market fell. 12th March, 16th March, 23rd March. And 16th March, it fell by close to 8%. And 16th March again, both are closed. Both 12th March and 16th March, it fell close to 8%. And 21st January 2008 financial crisis led to 7.4% fall. And 2006, because of high US consumer price index reported, Sensex lost 6.76. So today also, market fell some 1.4% because of higher than expected consumer price index in the US indicator. The market fell around 1.4%. And March 2008 financial crisis, again 6% fall. And 2015 global market and China's stock problem led to 5.93% fall. And number 2016, due to demonetization, it fell 5.9%. So all these are big fall. If big fall happens, if you are in the long, if it is leveraged, you will lose money. Many of our youngsters, it was in the leverage position, they lost money. So you have to look at the history teaches us how to avoid these mistakes, how to learn from the past. And also, market goes up, not only largest fall, largest increase also happens. So, biggest single day gain, April 2020, that is during COVID time, there is March, it fell down by 13.15%, April 12.7%, same thing April 7, it rose 8.97%. You see, 23rd March, 13% fall, 7th March, 8.97% rise, and 28th April, 16th March, 7.96. So, market can go up or come down very drastically. February 2021, market went by 5%. May 2009, imagine 17.34% rise. Suppose some people, what they do, they not only long means you buy the stock, short means even without having shares, you can sell short. If you're a day trader, if you shorted on that day, your entire capital wiped out. September 20th, here I left it out, Sensex fell by, so increased by 5.32. And March 2020, 25th March, gain up 6.96%. Suppose here, 23rd March, market lost 13.15%. And 25th March, it gained 6.96%. And see, imagine, 23rd March, gain of 5.75, 25th March, gain of 6.96, but 23rd March, loss of 13.15%. So fluctuation within 3-4 days, huge. If you are not a long-term investor, you are short-term, whether you are long or short, you would have lost huge amount of money. So history teaches, but why do the people make mistake? Why do the people don't learn from this mistake? Due to various psychological biases. So one is overconfident bias, then confirmation bias, then availability bias, then loss aversion, training effect, so many biases. So it is very important that look at the history, look at the data, how stock prices moved, how stock prices even written, how individual stock also moves very high. Okay. Globally, people invest in the WorldCom. Even this, most of the employees in the US, people can invest in their own stock or portfolio stock for their retirement benefits. See, India, usually government used to give pensions, so not much of, not bother to make investment. Recently, after the policy change, people started investing in provident fund. People started investing in the national pension scheme. People started investing in mutual funds. And usually have a diversified portfolio. But the WorldCom, the US company, when collapsed, many of the WorldCom employees invested only in WorldCom stocks. They lost entire money. So this mistake happens again and again. So why people make this mistake? How these mistakes can be avoided? Why history of stock market and this written behavior, why is not teaching people? So let us start with the history of Bombay Stock Exchange. Let's look at the history of Bombay Stock Exchange. Shares traded in 1980s in Bombay with the start of bank and cotton prices. That is 1980. Bank stocks and cotton prices stocks started trade in 1930s. And the stock exchange is born in India in 1950s when 22 brokers started trading informally opposite the downtown of Bombay. In 1974, it's moved to Dalal Street. This is an informal group of brokers, Native Share and Stock Broker Association, organized themselves as a Bombay Stock Exchange. There was no regulation. In 1956, Securities and Contract Regulation Act granted permanent recognition to Bombay Stock Exchange and started regulating Security Contract and Regulation Act 1956. These brokers interested in own benefit, interested in own promoting own self-interest, but were not invested much. That later Security Exchange Board of India came and National Stock Exchange came, that changed the entire things. And suppose the stock market crashes and booms, it's happening from the very beginning. 1865, American Civil War happened. 1865, American Civil War happened. Increase in demand for cotton due to American Civil War because cotton is needed in 1861 to 1865. This led to sudden and sharp increase in price of cotton. So when price of cotton goes up, those companies producing cotton, those companies exporting cotton, they made a huge profit. So those companies producing cotton, those companies exporting cotton, they made huge profit. Because of an increase in profits, these stock prices started going up. So when these stock prices started going up, people thought this stock price going up is permanent like this. They started buying these stocks. Also, those made money. That is, suppose I'm a producer of cotton, not that. Suppose I'm a cotton producer. That is, I'm a agriculture cotton producer, cotton balls. I am also started investing in these stocks. So people are become greedy. People thought it's going to go up only. There is no down. But by 1865, after 4 years, Civil War ended. When Civil War ended, demand for cotton declined. When demand for cotton declined, stock market crashes. Once crashes, what happened? More people start selling. More people have leverage problem. More people have not sustained. The stock price started declining very sharply. The people lost money heavily. So those people in this memory of this, they never will enter the stock market. So after that, what happens? In between, we don't have much of data. enough. That's yes, we can get it, but you have to do large effort. Let us see. Certainly, stock market started functioning. We can say effectively. This was functioning effectively more started from Rajiv Gandhi's new era. Sensex goes from 233 in May 1984 to the Sensex index. This is the index number 233 to 665. That is, we invested 223 rupees in these 30 stocks in 1984, would have grown to 665 in February 1986. So more than 250% increase in stock price. So why it happened? Reduce the import tariff. Reduce the import tariff on computers, medical equipments, other equipments. Also, government did automatic liberalization. If you are manufacturing two-wheeler, you can manufacture three-wheelers. If you're manufacturing three-wheelers, you can make four-wheelers. Also, government, many companies, they're given license for producing some fixed number of quantities, maybe 1 lakh tons. But the companies might have had illegally 1,10,000 tons of capacity. That automatic liberalization, they allowed, they legalized. All this led to boom of stock prices. And also during Rajiv Gandhi time, there was a huge external borrowing as well as huge internal borrowing. That is, we had a huge fiscal deficit financed by both external and internal borrowing. This lead to sharp rise in the stock price. So again, bull market. So this bull market is not going to be permanent. It is alternate by bear market. So bull runs of 1992, you would have heard of it. Also before that, 1991 or end of 1990. You know what happened? India had just foreign exchange reserves, few weeks of, you can sustain only few weeks of imports. You can cover only 15 days of 2 weeks of imports. And India not had a foreign exchange reserve. India had to ship our Reserve Bank of India gold reserve to Bank of England. That led to that time also sharp decline in the stock price. So Rajiv Gandhi bull era. Then because of foreign exchange crisis, we have to ship Bank of England. Our Reserve Bank of India had to ship our gold to Bank of England. And that time also stock price decreased very sharply, market lost. So people have both optimism and pessimism comes and goes. In 1992, you know, Sensex in January it was 127. In April 1992, within 14 months, it rose 350% return is given. Why did this happen? Dr. Manmohan Singh started liberalization, privatization, globalization. So what are the liberalization, privatization? Many are opened up to private sector. Car manufacturing, TV manufacturing. So for research for public sector enterprises thrown open to private sector to produce. Also globalization. Government allowed reduce the tariff, import tariff. It also liberalized many areas. Privatization, liberalization, all led to stock market going up. Also, when stock market goes up, always somebody comes and brokers or some cartel comes and manipulate the stock price. Then we had during Harshad Mehta time, that is same the 1992, stock price of ACC went from rupees 200 to 9,000 in just 3 months. 3 months. Just sorry for a mistake. So we went from 200 to 9,000. And suddenly there is a scam. There is another scam came out. How Harshit Mehta did, he colluded with the bank employees, get the fake bank receipt issued. You use this bank receipt to get other banks to lend his money, and using that money, he invests in the stock market. See, bankers' receipts are receipts given by the bank to the other party. He has government securities in his account. Okay. So with these government securities, he is depositing, he lending to. So what Harshit Mehta is, using these bankers' receipts, he given to some banks, he borrowed money and put it in the stock market. So stock price went up. He had a selective stock, he used to stay invested. So it's invested in Sensex goes from 2000 to 4000. That is the scam came to know the market crashed. You know that how much market crashed during the scam? You know that 12.7% on 28 April. 28 April, due to Harshit Mehta scheme, it decreased 12.7%, almost 13%. Some stock might have lost 30-40%. So if you invested, you lost everything. So this scam, because of this scam, people are becoming skeptical. People are running away from the stock market. They don't want to invest. But still, good number of people, the faith in the market, they invest in the long term. And also, this is the time during bull time, lots of people very confident, and they learned the market behavior. They thought they can make money. They started investing heavily. Some people have borrowed leverage heavily. They borrowed from relatives, they borrowed from banks. Some of them hypothecated a house and taken loans. When market crashed, they lost the money because you're highly leveraged. When you borrow, some people borrowed against the shares. When share price decreases in value, what banks will do to recover their money? They sell the share. It again leads to fall in the price. So, come on. So during that time, previous one, the market was not transparent. There is no electronic trading. So delivery used to take place 14-15 days. This is to establish National Stock Exchange. It's a very transparent. BSE National Stock Exchange started in 1994. It is automated trading. Because of this, Bombay Stock Exchange lost business to National Stock Exchange. They are forced to introduce online electronic trading system known as BOLT in 1995. Okay. And BSE, we already seen sensitivity index started in 1978-79 as a base year in 1986. BSE Sensex started in 1986 with 1978-79 as a base year. National Stock Exchange also Nifty 50 index in 1996. Why this index is important for us? This index gives, suppose Sensex in 1980s, 1978, 79, 100 means now 60,000 means if you invested 1978, 79, 100 rupees, it would have become 60,000. So 600 times increase. And see, scam and boom, cash market crash and boom taking place frequently. In 1998 to 2000, Sensex doubled. 2,764 to 5,934. Because India was a2 problem, IT. India was IT sector was booming, technology booming, Infosys, TCS, Wipro, many other things. So that time, what Ketan Parag is a broker. He considered K10 stock, that is K10 stocks, Pentamedia stock, Pentamedia Graphic, HFCL, GTL, Silver Line Technologies, Rand Galaxy, Z Films, Global Trust Bank, DSQ Software, Aptech Infosys, SSI. Some mistake on extra added. So what happened here? The stock prices increased many-fold. What he used to do? He used to buy 20% of the stock. The stock price go up. Then what you do? When stock price goes up, immediately after some time you dump it before those latecomer realizing it. See, when he buys 20 to 30% of stock of a company, stock price goes up. Once it goes up, what he does, he sells immediately. By the time these investors don't know, they followed him. They lost everything. This scam broke out. Okay, so you have to see this is individual brokers are manipulating, or entire market is manipulated. Some individual stocks are manipulated. Do people learn from this mistake? I don't think so. But some of them learn, but they leave the market. They don't invest in the stock market. Okay. And 1993-94, again bull market due to GDR, that is global depository receipts and foreign institutional investor. What do you mean by that global depository receipts? Indian companies raised foreign exchange dollars or euro, GDR global depository receipt they issued to raise the money, equity shares. So that led to a lot of money coming to India, forex, the stock price started going up. Foreign institutional investors also allowed to invest in Indian stock market. That also lead to increase in stock price. July 1993 to September 1984, there was India bull market because of global depository receipts and FII. So one thing is clear from this: when foreign institutional investors invest in India, so stock market like to go up. So India, because of global crisis, 2008 recent crisis, led to lot of foreign portfolio investment coming to India. So that leads to increase in stock price. When they pull out, stock market crashes. But what young people think it is like permanent stock price going up because they have short memory. They recall from recent memory, they do this mistake. Then 1998 in May, Sensex was 4,000. And October 1998 it crashed to 1740 because of India was conducting nuclear test on 11th and 13th May. So US imposed, the foreign countries imposed sanctions against India, suspended foreign aid, terminate sales of any military items, stop credits are guaranteed to country by US government agencies, prohibit US banks from making loans to foreign governments concerned, and prohibit export of specific goods and technology to India. So stock market crashed. So you see this, you see frequently market up, market down. Is it alternative? But those things, bull market, they think it's a permanent going to be. They're very optimistic, very overconfident. Those when market crash, some people are become pessimistic. They become lost in the market. They totally out of the market. They lose money. This in the sense, long run they don't invest. They satisfied with low return instrument they invest. That is bank deposits, LIC policies. They don't take risk. So both greedy people lose money, and those of fear, they lose opportunity cost of opportunity of earning more money. So bull run of 2004-2008, Sensex rallied from 6,250 to 21,200. Imagine what percentage increase, more than 300% increase. That is the time Indian economy was growing at the rate of 8 to 9%, 2000-2008. So real estate boom around the world. Throughout the world, real estates are booming. Why real estate are booming? There is a very low rate of interest. Banks not had much lending opportunity. So what banks did, they started lending to real estate. When they lend to real estate loans, there is a strong incentive for the banks to give loan without assessing their credit worthiness. Do they have ability to pay? They given loans to ninjas. What do you mean ninjas? No income, no job, no assets. No income, no job, no assets. So what banks were interested? Only giving the loans. There is an asymmetric information problem because buyer knows better than the lender. Lender also has own self-interest. They're not looking at the bank's interest because their promotion, their benefits all based on how much they're lending, how much they're earning that particular period, not after the problem arises, whether they make money. So when the profit, short-term profit only banks are looking at, they got bonuses and other shares. But when market suddenly crashed, so people lost money. So 2004-2008 led by real estate boom around the world. The bank given ninjas loan, also mortgage crisis, also global infrastructure led boom. So China investing more, and also commodity prices skyrocketed. Because the commodity prices skyrocketed, there is international oil prices and zinc, all aluminum, etc. prices are going up. So that led to bull run. Okay, steel prices, aluminum prices, that led to India bull market. So real estate boom, yes. All this leads to boom in the Indian market. And suddenly global financial crisis comes. So what happened? Sensex in end of 2008, it dropped from 20,465 points to 9,716, 50% drop. Why Sensex dropped? On January 21st, Sensex dropped by around 1,400 points. Why? Because of collapse of US housing market, because it's fueled by lower rate of interest. When 2008, when Federal Reserve Bank increased the rate of interest, people not able to repay the loan. Because people not able to repay the loan, banks started selling the houses. Also subprime crisis. Subprime mortgages. What subprime mortgages? The bank given loans. Suppose banks given loans, credit card loans, housing loans, and education loan. All these loans have again restructured. Yes, lend it, sold as a products. So when housing prices started dropping, when house price started dropping, those banks started selling the house. Again, market price came down. So they have collateral problem. When banks has their equity goes down because bank lost money. When equity goes down, bank has less money to lend now. Because bank has less money to problem, the crisis started. Then that is the time Federal Reserve Bank started giving huge purchase of assets. Generally, Reserve Bank, Federal Reserve buys government bonds. That is the time they bought mortgage asset also. Okay, they bought subprime assets. So that kept economy going. Okay, that kept the economy going. So that they have to do that. Again, okay. Also, India co-location. What do you mean co-location? Stockbrokers had the computer terminal in the stock exchange. when some, not all the brokers, some privileged brokers, those preferential brokers, they kept their server co-location. When they keep in the national stock exchange, this order will be faster. They can see the order coming. Then the split second they can access the data and make faster decision. That leads to some substantial advantage to some brokers. So these brokers have multiple. The single broker had multiple login first and second or third. The first login or second or third, they had an edge. So they made this, they can see the orders, they could see the orders are coming from that aggregated before anybody is knowing. If I have co-located, I can see the order much before others can see. Because of the advantage, I made money. Those brokers started making money. This fraud came out and National Stock Exchange, SEBI has punished them. Then algo trading. What is algo trading? Algorithmic trading refers to orders generated at super speed by use of advanced mathematical tool models that involves automated execution of trade, no manual interventions. Algo trading is algorithmic trading. Seeing certain conditions met, order is executed automatically. An algo trade could be sell 1000 BPCL sell for every time rupee depreciate by 3% against dollar. So BPCL, what BPCL do? Bharat Petroleum Corporation Limited, they import petroleum products. When rupee depreciate, they have to pay more. So this gives order, if rupee depreciate 3%, sell 1000 shares. Algo trading, another could be, if rupee depreciate by 5%, buy 400 TCS shares. So TCS shares will value go up and rupee depreciate because same dollar they were getting more rupees. So this algo trading, automated trading, this might lead to future there is a problem. You have to learn from history. So many automated trading take place. What happened? Price become fall sharply. So many people are leveraged margin trading. So they might lose money heavily. It's not only they lose money, they putting the entire system to the other risk. Entire system. Entire stock market system at the risk. So do people learn from this? Let's see. Okay. So why this might happen? The algos deployed by retail investor using API, neither exchanges nor are brokers able to identify this particular trade emanating from API is an algo or non-algo trade. Retail using API, you can't find out is an algo trade or non-algo trade. This unregulated algos poses a risk to the market and can lead to systematic market manipulation. We lose the retail investor by guaranteeing them higher returns. Okay, so you want to see. So the history repeats, but people mistake also repeats. The greed and fear comes again, same thing. See, look at the bull market phases. 1985 to 86, 24 months. Rajiv Gandhi New Era went up by 190%. 1992, Harshit method, that scam and liberalization of economy, it went up 300%. IT boom, 1998 to 2000, it went up by 120%. 2003 to 2008, that is global liquidity, housing boom, it led to 610% return. 2013 to 19, 220%. You see, huge variation. This 5-year return is 610%. Okay, look at the variation. So, if you're a long-term investor, yes, it's a good for you. If you're a trader or if you're very short-term, no. So history teaches us, but still people fail. And on February 2016, Sensex dropped by 26% just 11 months. When you see your 11 months, you have invested 1 lakh, just now it is 74,000. Some of stock price fell even sharply, maybe 60% lost. You invested 1 lakh, now its value only 40,000. What people feel? Oh, get out the stock market, get away from this. This is not their cup of tea. So you're missing opportunity to learn. What is the reason for Sensex falling in 2016? Because sharp pricing NPA of Indian banks, non-performing assets. Indian banks not able to get the loans back. They're not getting the loan repaid. And also 2016 November, Sensex dropped by another 6% due to demonetization. So this is clear. So stock market might go up, stock market might come down, but you should be in the long run. Look at the Sensex 1980, and somewhere around 100, now around close to 60,000. Suppose you invested 100, it will become 60,000. Okay, so it's clear from this above. What is clear? Greed and fear of stock market. You carried away with bull market, you become greedy, and if you're not careful, you lose money. In the bear market, you become fearful, and you lose money. So you should think of long-term investment. You should have control. You should have overconfident bias or confirmation bias or loss aversion or various biases. So that is important for you. Mr. Rohit, any question now? Hello?
No, sir. Thank you.
So I can continue, or what is that now?
Sir, thank you, sir. There are no questions. Thank you for.
Okay, thank you very much. Thank you, Kiran. Thank you, Roshan.